Hello and welcome to Econoday Unplugged. It's Tuesday, the 11th of February 2020. Mark Pender is the other side of the water stateside, and I'm Jeremy Hawkins here in London. Well, it's the coronavirus that continues to dominate most of the media headlines, although equity markets are doing a pretty good job at ignoring them, or at least anticipating only a temporary and probably just a small hit to global demand. However, with so many uncertainties involved, this may be too optimistic, particularly given the vulnerability of many economies to disruptions to global supply chains. Talk about a V-shaped rather than a U-shaped bounce back in economic activity could yet prove premature. In any event, central banks seem to be taking more note. And with this in mind, we have Fed Chief Jerome Powell testifying to Congress both today and tomorrow. So, Mark, Mr. Powell finished his address just a short while ago, at least his first one. How concerned do you think the Fed is now about the virus? And while we're on the central bank, what do you think they made of January's employment report?
Well, let's step back before the virus. Jerome Powell highlighted it as a risk and that they're monitoring it. They don't expect. They do say that it could spill into the global economy. But right now, it's not a major risk. It hasn't changed their balance of risks in their outlook. It's wait and see on the coronavirus. Before talking about jobs and how the Fed probably looked at the January report, which was very strong, which lacked the wage pressures. Let's turn to something that came out this morning, which was job openings. Now, in his statement, Powell noted that job openings remain plentiful, which was an interesting thing for him to comment on because just as he was delivering his commentary, the job openings report came out, and actually they were very low. It was at roughly two-year lows relative to the number of unemployed looking for work, and also relative to hires. So the separation between openings and hires is narrowing very sharply, which means less and less wage pressure, which means the demand for labor relative to supply has been easing. So that's.
Can I just quickly interrupt there? Is this number particularly volatile, or do we place that much attention on this particular number, or do we look at a series and see what the trend's like?
No, it's a legit number. It's done by the Labor Department. It's done by the same bureau that's calculating the employment report. Mm-hmm. So it is a legit number. It came out to 6.423 million openings. In December. It does lag by a month, but there were 5.753 million unemployed. Now, that number has also been shrinking. So there's fewer job openings and fewer people looking for work, and the number of hires relative to hires has been going up or narrowing. So that means that demand relative for labor relative to supply is going down. And for a Fed that's trying to create inflationary pressures, wage growth doesn't look like it's going to participate in this. So I think that it actually, for the markets, it's not a bad indication, because we're getting the best of both worlds. We're getting very strong levels of full employment. At the same time, we're not getting any inflation that would trigger a rate action by the Fed.
Okay, interesting. So, did Powell come across as still being confident the Fed's going to meet its inflation objectives?
Yes, he's saying that he's repeating prior comments that inflation is likely to move toward their 2% goal. Like it was 1.6% of the PCE last, both overall and both for the core. In January's data, so it's supposed to get up to 2%, and it may be approaching that. But now we also have a decline in the price of oil, which is tied to the virus, and perhaps to lower demand expectations for fuel in China. So it doesn't look like it's a very inflationary environment, but I'm sure he'll be addressing that in his commentary this week as he begins to take questions and answers. Well, let me switch gears if I can. Today out of the UK, we had a run of data, And it was interesting, the separation between the GDP for December and the GDP for the fourth quarter. I mean, when the quarter seemed to end on a good note, but overall the quarter wasn't so hot. I mean,
yeah, that's exactly right. And I suppose it's kind of gives something to the hawks and the doves alike as far as the MPC is concerned. So as you mentioned, in terms of December, now we have this monthly suite of GDP figures out of the UK. That showed a monthly increase in total output of 0.3%, a little bit stronger than expected, and also large enough to wipe out the 0.3% decline we saw in mid-quarter. So at least, as you mentioned, we had a pretty respectable end to 2019 for the UK. However, these monthly numbers are volatile, and you're putting a straight line through it for the fourth quarter. Well, the level of GDP in the fourth quarter was unchanged from its level in the third quarter, which certainly indicates a slowdown, I think, in underlying momentum. That said, again, if you're looking perhaps to be from the more hawkish side, the good news within that is that the third quarter number itself, growth there prior to today's release was put at 0.3% quarter on quarter. That's been revised up to 0.5%, which, to be honest, by UK standards at the moment, particularly if you believe what the Bank of England's thinking about, that really constitutes a pretty good number indeed. So I think really you can say that the economy ended okay, but was certainly slowed down during the course of the second half of last year, and it really now comes down to what is going to happen as far as January is concerned. I think really in terms of the December data themselves, they probably at least slightly reduce pressure on the bank to come out and cut interest rates. But as they said at their last meeting, the first quarter is going to have to show some kind of rebound in overall economic activity if markets at least aren't going to start speculating very quickly about a near-term cut in interest rates. Next BOE meeting is in March time, so we'll have at least some numbers coming through for the first quarter, hard numbers by them for the first quarter, and they're going to be particularly important to what happens to the pound and sterling markets in general.
Net trade looked to be a positive here.
Don't mention net trade. Oh, I hate the net trade numbers. I really do. With a passion. I think it's quite interesting. You can almost get anything at all now out of the UK trade statistics, and financial markets completely and utterly ignore them. Now, it should be mentioned that the trade numbers, which I know perhaps quite a lot of attention is placed stateside, and obviously with the US Chinese trading relationship and everything else, a lot of financial market weight is attached to those numbers. But when it comes to the UK, well, the trade figures over here, they lost their so-called national statistics status back in November of 2014. Ever since when the national statistics have been trying to improve the quality of these figures, but markets by and large don't really believe them. So just to quickly put a few numbers into the pot. Today we saw the main focus number for the UK is the trading global goods. So the goods side of the merchandise trade balance, that showed a surplus of just under 1 billion, which is an all-time record high. Previously, we had a deficit of just around about 5 billion. And for months and months prior to that, we've been running in double-digit deficits. Now, the reason for the improvement into a surplus as far as December is concerned was that we had a monthly increase in exports of 17.4%. Which is a positively ridiculous number. Now, it looks as if by far and away the bulk of that came out of semi-precious stones or non-monetary gold, which goes straight into the UK accounts. Because London is such an important gold bullion trading centre, inflows and outflows of gold bullion can have a big impact upon what's going on in the headline trade numbers. And it seems as if it's had a particularly big impact this time round. And to be honest, if you strip out the various erratics, and that means non-monetary gold, precious jewels, and also oil, which has a big impact on the UK trade figures as well, then we're still talking about an underlying trade deficit of around about 7.5 billion or so, or something like that. So there may have been a slight improvement, but nothing like what's indicated simply by looking at the headline number.
What is the outlook for trade post-Brexit?
Don't know. is the very honest answer to that, because really, until we get these trade negotiations finalised, and that's presumably going to take until the end of this year, which is the deadline, nobody really knows quite what's going to happen. As it currently stands, it would appear that Boris Johnson and co are trying to sort out as many different trade deals as he can with countries outside of the EU, while at the same time trying to cherry pick and get the best possible deals he can with the European Union, which we've only just left, of course. So put that little lot together, and I mean, it's trying to get a round peg in a square hole. It ain't going to work. Exactly what bits he's going to find to get out of which particular areas, we'll simply have to wait and see. But it is clearly extremely important for financial markets because UK is a very open economy, exports a very big share of UK GDP. You're talking about 25% or so. So what happens to UK trade will have big implications for the way UK GDP growth and interest rates, and obviously everything else pans out in the future.
Can we shift to Germany real fast?
Yeah, please do, because I want to touch on Germany.
Okay, go. Well, I wanted to ask about trade in Germany. And if there's any kind of similar issues about the quality of their data, or how closely trade is watched in Germany relative to something like industrial production. We also had industrial production coming out today out of the UK. But what do you see for German GDP? Is coming out Friday?
It is, that's right, and it's a good one to talk about. Let me just back up a little bit and say, from the way the Eurozone as a whole is looking at the moment, and always remember that Germany is the best part of 30% of the entire Eurozone. December for the Eurozone is looking, well, really pretty awful. We've had December retail sales, which for the Eurozone as a whole were down 1.6% on the month. That's their fourth decline in the last 6 months. Is their worst performance on a monthly basis since March 2008. Now, why is that? And it takes us to your question about Germany. Well, Germany is really struggling at the moment. We're seeing horrible numbers on sales. We're also seeing, in particular, still horrible numbers on industrial production. So for German IP for December, we saw a monthly collapse of some 3.5%. That takes the level of output down to its weakest level since August 2014. That really just highlights what dire states German manufacturing is in at the moment. Now, it means that for the fourth quarter for German goods producing sector, the quarterly change was very nearly down 2%. So we're really talking about deep recession. And just to rub salt into the wound, orders are still declining as well. On a fourth quarter basis, they were down another 0.6%. So Germany at the moment is really giving the Eurozone a major problem. Now, talk about German GDP on Friday. The market call on that at the moment is for an increase of 0.1%. But to be honest, in light of the industrial production figures we had out last week, it wouldn't surprise me if we see something weaker than that.
And this is tied to global markets.
Sorry, say again?
Is this tied to global markets?
It's certainly partly tied to global markets, because what we have seen amongst Europe is with the problems for global trade we've had over the last couple of years or so, best part of, one country which has been disproportionately hit has been Germany, simply because exports are so important to the German economy. Depending upon which quarter you pick, overall exports can be worth half of entire German GDP. So we've seen exports being hit quite significantly by the slowdown in global growth in world trade. Talks about tariffs between the EU and the US, problems just generally with what's going on, and Germany's been disproportionately impacted by it. And it looks now, we've got the slump in German industrial production down 3.5%. In December. If we overlay that with the other countries had out, France was down 2.8%, Spain 1.4%, Italy 2.7%, and that's 3/4 of the total Eurozone industrial production. So it looks as if the industrial production figures out of the Eurozone on Wednesday morning are really going to look pretty horrible.
Where did all this come from? The forecasters didn't see this. I don't remember anything in the news indicating this is almost like a dislocation, right?
It is. I suppose you're trying to find any kind of positive spin on this is the fact that the numbers really are awful. It's not just Germany, but no one was expecting to see French industrial production down 2.8. Italy, we know, has been weak, but not down 2.7% week. So it may be the case that it's comes back to something we talked a little bit before about, which is the seasonal adjustment process. Yeah. And around the turn of the year, we know it is difficult to get the seasonals right. So I mean, to be honest, December is guaranteed for Eurozone industrial production is going to look terrible, full stop. But it may be the case that we're going to see some kind of bounce back in January. Obviously, we don't know yet, but that's what the best we can hope for at the moment, because the fourth quarter is looking bad. Now, what does that mean? Well, you're talking about the Fed seem to be quite happy the way things are going at the moment. Well, there's talk now coming out from some sources suggesting that some of the smaller countries on the European Central Bank's governing council are already starting to try to push for another cut in interest rates. And that's to reflect the fact that the economic data, which remember when Christine Lagarde came in just a few months ago, she was starting to sound just this little bit cautiously upbeat, and everyone was saying, oh, perhaps the worst is over for the Eurozone economy. Well, the numbers by and large have been disappointing out the Eurozone, but still this perceived risk that we could get a hard Brexit once we get to the end of these trade negotiations. If they don't go well, that's certainly be a big negative for the Eurozone. And of course, that's all against the background of this coronavirus, which we don't know how big an impact that's going to have.
Well, speaking of the smaller countries in Europe, is it when Germany sneezes, everyone gets the flu? I mean, how are they doing? Are they suffering?
It is. I mean, growth looks to have pretty well dried up as far as a lot of the smaller countries are concerned. And that's also true of the early indications we've had coming out of the survey data for the start of 2020. And yes, because Germany is the powerhouse of Europe, effectively, as you say, if Germany starts sneezing, then the other countries dotted around it could catch a cold pretty quickly as well. So I think, again, we're going to see more pressure on the German administration to do something towards boosting fiscal policy with a view to getting growth going again.
So now, what about all those rate cuts last year? We've been waiting for them to take effect. Are we giving up on this now?
Well, I don't know. I mean, it's a good question. I think Lagarde, in some of their opening speeches, was intimating policy is extremely quantitative, and while she expected it to remain so, the expectation was that succession of rate cuts plus the quantitative easing, which we're back into quantitative easing mode from the ECB again now, should start to have some kind of impact. But the bottom line is it's not giving the kind of boost to GDP that people expected it to, or if it is, then the underlying situation was a good deal weaker than originally anticipated. Now, just quickly before we finish this, I've prattled on too long about Europe. It's interesting. There was comments coming out from Fiat Chrysler's European, one of their facilities. I think it was last week, and they were suggesting that they're only about a couple of weeks away from halting production because of problems sourcing Chinese parts. A number of their suppliers in China now are close to not being able to supply them anymore. And again, this is this kind of global supply chain which is starting to impact bits and pieces of the global economy now. And I think there's this sense of this coronavirus isn't pretty well sorted out, or at least factories really get going again in China the next month or so, then we could see perhaps more of a global hit to the economy than certainly stock markets are currently anticipating anyway.
Unless the stock markets are anticipating another round of rate cuts relative to this.
It may be. It's got to be said, stock markets tend to be very forward-looking. I'm surprised, to be honest, that they're quite where they are at the moment. You look around the screens and virtually every stock market is either at a record high or very close to it, or multi-year highs, or whatever you like. So I think they are taking a view that, well, this is going to be a temporary hit to the economy, and we'll get a quick recovery once the vaccine's been sorted out and everything else. But coming at a time when a big chunk of the global economy wasn't really in that great a shape in the first place, I kind of wondering if the bounce back, if this thing does persist for a while, may be rather weak than many anticipating. One last thing I mentioned is quickly some notices on the coronavirus, which might be interesting, and it will be useful when we get Brian on a couple of weeks' time. Singapore dollar last week may not be something we normally talk about, but it saw one of its sharpest falls in almost 2 years last Wednesday. And that seemed to reflect the fact that the Monetary Authority of Singapore, so their central bank, said that while the current policy stance is fair enough, the Singapore dollar still had room to weaken as a result of the coronavirus. And it kind of wonders as if you're going to start getting into the risk of some sort of FX war, whereby those those countries which are most hit by the coronavirus are going to start to look to acquire some kind of stimulus by allowing their currencies to weaken. And clearly, there are going to be a lot of other countries around the world which wouldn't be too happy were that to come about.
Well, let's all remember 20 years ago, right? It was the Asian 97 currency meltdown, and that triggered all sorts of trouble.
It did indeed. So very interesting times one way or another. Okay, well, I guess we've been talking for quite a while. Anything else you want to chip in before we round off?
No, I guess we're pretty well covered it. I guess what about the Fed is, are they going to tilt to the easing again in an election year? I'm not sure. They'll be very reluctant to do it. Maybe they're going to extend their repo purchases up. It looks like until June. They won't actually come out and say. And Powell kind of in his.
Weren't they talking about to April before? Have I got my?
To April, right? And now, if you read the what the Fed people are saying, June has popped in to the conversation.
Oh, right.
Right, and so, but it's going to be gradual. So they're going to say that it's going to be less and less of an impact. But they haven't. It hasn't really come out exactly when they're going to stop. And that's hundreds. That's a lot of money into the banking system, and also China put a lot of money into the banking system. So we're talking about hundreds of billions of dollars going into the banking system at this time, which is another factor that will help limit the impact of the virus, and also will help veil policy action if they. So they don't have to actually do a monetary policy move with an official rate cut if on the side they're pumping money into the banking system. Yeah.
Supporting all these stock markets at interesting, let's say, levels. All right. Okay, then. Let's wrap it up there. From Mark and myself, thanks as always for listening. Don't forget to tune in again next week. And in the meantime, don't forget you can find all the key market moving data and events listed and analysed in Econoday's global economic calendar. We'll see you next week. Bye for now.